Have you ever wondered how the stock market really works and what's behind those price swings? In this video, I'm going to break it all down, from how companies raise money to how stock prices move and why owning a piece of a company can be your ticket to building real wealth. Stick around as we uncover the mechanics behind the market and how you can use this knowledge to your advantage. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. People often talk about using the stock market to build wealth or gain financial freedom, but what exactly is it? The stock market is a vast global network where money moves every day. Instead of buying products like in a store, the stock market deals with securities, financial assets that represent ownership in something valuable, like a company. When you own a share, you own a small part of that company. Stock exchanges act as marketplaces where buyers and sellers trade these shares. Companies list their shares on these exchanges, and their stock prices fluctuate based on how much investors are willing to pay. Modern technology allows these transactions to happen electronically, making trades nearly instant and ensuring fairness and efficiency in the process. But what does it really mean to own a stock? It's not just about holding a piece of a company, it's about becoming a part owner. This ownership grants you rights, such as voting on important company decisions and possibly receiving dividends when profits are distributed. In short, owning a stock means sharing in both the risks and rewards of the business. To grow a successful business, founders need the right resources. Picture the company as a pie, and each slice of that pie represents a share in the business. To fund growth and expansion, companies often sell these slices. A common way they do this is through an initial public offering, IPO, where they offer part of their shares to the public for the first time. Essentially, the company goes public, allowing anyone to purchase a piece of the business and become a shareholder. For companies to sell their shares to the public, they need a platform where these transactions can happen. That's where the stock market steps in. Around the world, there are various stock exchanges where shares are bought and sold. In the US, we have the New York Stock Exchange and NASDAQ, while Canada has the TSX. Other countries have their own exchanges too, like India's NSE and Japan's JPX. Together, these exchanges form a global network, allowing companies to raise capital and keep growing their businesses, no matter where they are located. Take Facebook, for example. During its initial public offering, Facebook sold more than 421 million shares at $38 each, raising over $16 billion from investors. Generally, the price of a share mirrors the company's performance. As the company grows and becomes more valuable, the individual shares also increase in worth. This is a win for investors, as their initial investment rises in value alongside the company's success. Stock prices don't always match a company's actual performance. A rumor or negative news about a company can cause its stock price to drop, even if the business itself is doing well. On the flip side, investors may rush to buy shares of a company if they believe in its future potential, even if the company isn't profitable yet. This can help young companies raise money to grow. A perfect example is Snapchat, which wasn't profitable before it went public, but still managed to raise over $3 billion through its IPO. However, the stock market is not just about the company's real value. It also reflects the combined speculation of millions of individuals. People often buy and sell based on emotions, news, and trends, rather than fundamentals. This speculation can drive a company's stock price far beyond its actual worth, creating a bubble. When reality catches up, the bubble can burst, and investors may face significant losses as prices crash back down to earth. A clear example of this was the dot-com bubble in the early 2000s. During this time, investors eagerly backed new internet startups, believing the rapidly growing industry would deliver huge returns. Many companies had little to no revenue, but their stock prices skyrocketed. When these businesses failed to meet expectations, panic selling began, causing stock values to collapse and contributing to the 2001 economic recession. Share prices are influenced by a wide range of factors, often more complex than they appear on the surface. At a basic level, they fluctuate based on supply and demand. If more investors want to buy a stock than sell it, the price goes up, and vice versa. However, the forces driving supply and demand can vary significantly. A company's financial performance, such as its earnings reports or revenue growth, plays a big role. Positive results can boost investor confidence, while disappointing numbers may cause a sell-off. Beyond financials, a company's public image and reputation can have a huge impact. For instance, news of a groundbreaking product or strong leadership can attract buyers, while scandals or poor management decisions can drive them away. Broader economic factors like interest rates, inflation, and geopolitical events also shape market trends. Even investor psychology and herd mentality contribute. Sometimes share prices move simply because people are reacting to others, not the actual value of the company. These dynamics result in daily price swings, which can feel chaotic in the short term. But there's two key strategies that can help: diversification and a long-term approach. Diversification spreads your risk by investing across various companies, industries, or asset classes. ETFs, for example, offer an easy way to invest in a wide range of stocks, like the S&P 500, with a single purchase. Meanwhile, focusing on the long term helps you ride out short-term volatility. Looking at history, while the stock market has faced recessions, crashes, and corrections, the overall trend, particularly in the US, has been upward. Events like the Great Depression or the 2008 financial crisis caused significant declines, but recovery periods have consistently pushed markets to new highs. This long-term growth is fueled by innovation, expanding economies, and rising productivity, making the stock market a powerful tool for building wealth, if you can stay disciplined enough to weather the short-term fluctuations. The stock market is where businesses and investors come together, creating opportunities to fuel innovation, drive economic growth, and unlock financial potential. Whether you're investing to support groundbreaking ideas, secure your future, or simply be part of the world's economic engine, the stock market offers endless possibilities if you know how to navigate it. And as always, thank you for watching, and I will see you in the next one.